In the exercise of powers conferred by the section 133 in the accounting standard, in the rule book itself, we have laid out certain terms and conditions any company may comply with the Indian accounting standards for financial statements, accounting periods. Every rule or every application that starts coming into picture will have an exemption. Good morning and welcome to the session 6 of Unit 1. And here we are going to talk about the accounting regulations in the new Companies Act of 2013. All of us know that after the Companies Act of 1956, we had gone in for an amendment several times, but then the Companies Act of 2013 stands as one of the most important amendment that has been used today for the regulation of companies and the various legal compliances. Now, moving forward, let us try to understand how does this come into picture and what is the importance behind this. In the exercise of powers conferred by the section 133, read with the section 469 of Companies Act 2013. This is an exact extract taken from the law book itself and the subsection 1 of 210A of Companies Act 1956. The central government, in consultation with the National Advisory Committee on Accounting Standards, hereby makes the following rules, namely saying that the short title and commencement, these rules will be called as going forward the Companies Accounting Standard 2015. And they have come into force in the year April 2015. So you can just look into the Act itself. This is the bare Act where I'm trying to talk about as per the section 469 of Companies Act of 2013 and the subsection 1 of section 210A. The government, in consultation that with the National Advisory, they came up saying that the amendment of this National Standards Accounting Act shall be coming into effective from the first day of April 2015. So that is the starting point for all of us where we started getting into in terms of implementation of the new accounting standards, followed by the applicability of the new standards altogether. Now, if you look here, the accounting standards are specified in the annexure to these rules called the Indian Accounting Standard and shall be applicable to the classes of companies specified in the Rule 4. So what do you mean by this entire ideology here is that it says very, very clearly that the accounting standards which are specified in the annexure, which means which have been already told in the document, will be called by the Indian accounting standards, is applied and applicable to the classes of company as per the Rule 4. So what we try to do here is that in the accounting standard, in the rule book itself, we have laid out certain terms and conditions, certain factors altogether saying that yes, we will be following these rules, we will be following these regulations, and you need to follow all these factors strictly. Now, why this becomes important, why it is mandatory for all of us to follow and take it forward is because it is applicable in certain levels and certain standards only. You cannot be doing it at all levels, at all possibility and feasibilities. So when it's been mentioned that this particular class of company, this particular class of the institution will be taking it, they have to follow the standards as prescribed, followed by the accounting standards specified in annexure to the companies. Now, this is what we are talking about. 2006 shall be in the accounting standards as applicable to the companies other than the classes mentioned in Rule 4. Suppose your company is not being mentioned at the first level standard of Rule 4, then automatically when we move on to the rules amendment that happened in the year 2006, your company will be mentioned in the other classes altogether. So that means to say that there are classes, there are subsections under which the companies are listed. Based on that only the listing will take place. The ideology of bringing in the applicability of accounting standards. A company which follows the Indian accounting standards specified as per the annexure, these rules in accordance with provision shall follow such standards only. So the first level itself, Indian accounting standards have told very clearly that if you are an Indian company trying to follow the standard, you need to comply with this. You cannot go ahead and have any deviations, or you cannot have any marked differences altogether. Which means to say that at some point of time, if you are trying to deviate yourself from this factor, or you are trying to deviate yourself from this entire ideology, then this is not going to work out at all. So that is why we say that the rules, the amendments have been made very, very specific and clear for all the people here, telling that this is what it needs to be done, this is how it needs to be taken forward altogether. A company which follows the accounting standards specified in the annexure as mentioned in the year 2006 shall comply with the same kind of standards only, and not with the standards in the annexure specified to the other factor. So whether you are coming in the 2004, that is the rule 4, or in the rule 6, the Indian accounting standards tells you very, very clearly that how you need to follow, what are the factors that needs to be followed, and how it needs to be taken care in terms of reporting. So what we are seeing here is that the applicability of accounting standards is becoming really stringent. Why? Because we understand that for a country like India, where there are different sectors, where there are different kinds of company, different classes of company, the accounting terminology, the methods of reporting, finding out the ratios, or understanding the financial implications might become tougher for the investor. So what did the Indian accounting standard try to come across is that try to bring in a standardized norm, a pattern through which each one of those people listed according to the classes, listed according to that norms, will follow it, and it will be easier for the investors as well as the people in terms of understanding the entire ideology. Moving forward, obligations to comply. Is it mandatory to comply with the Indian accounting standards as mentioned? The answer is definitely yes. Why? Because the companies and their auditors shall comply with the Indian accounting standards specified in the annexure to these rules. Why? Because this is mandatory in terms of preparation of financial statement and the audit respectively. Following, we will get into the rules now. Before we get in there, let us try to understand the companies and their auditors shall comply to the accounting standards specified in the annexure to these rules in preparation of their financial statement. Which means to say that if you are an auditor trying to audit the accounts of the Indian companies altogether, which means you need to apply the brain, you need to apply the thought process in such a manner that you will comply to the rules and regulations of the accounting standards that has been mentioned, that has been specified here. If you are not following those rules, if you are not following those regulations, then that will not be called a qualified audit. That will lead into trouble. So that's why the companies and their auditors have been specifically told that you need to carry forward with this accounting standards only. Now, any company may comply with the Indian accounting standards for financial statements, accounting periods beginning on and after of 1st April 2015 and the comparative periods of 31st March 2015 and thereafter. These new rules and the applicability of the accounting standards started only in May, that is in April 1st, 2015. And afterwards, they started saying that this becomes a rule that has to be followed mandatory. But then if you start looking at from the previous year of reporting, yes, you might look into it, but then it was made mandatory, or it was made an important factor after 2016-17 altogether. So starting from April 1st, 2015 onwards, this becomes a very, very important factor for all of us to follow. The following companies shall comply with the Indian accounting standards. Now, as mentioned in the subclasses, and they have to maintain the accounting period starting from April 1st, 2016 with the comparative periods of 31st March 2016 and thereafter. So keeping the previous year as the base year and starting from this year onwards, they have to follow this as a comparative standard and they have to report their financial statements accordingly. Now, moving forward, what are the exemptions? Now, every rule or every application that starts coming into picture will have an exemption, will have a factor that we need to look into. Now, what is the exemption that has been provided here? Now, if you look into the insurance companies, the banking companies, non-banking finance companies shall not be required to apply the Indian accounting standards. So they are not required to follow the IAS or the Indian accounting standards while preparing their financial statements, either voluntarily or mandatorily specified in the sub rule. Why? Because it was first very clearly told that for the manufacturing companies and the allied industries only, they wanted to bring in the Indian accounting standards, which will have a particular pattern in order to report. Now, if you look into the banking, the non-banking and the insurance, these are all in the services sector. So they will not have the same standard, they will not have the same methodology and the subheadings altogether. Because when you look into a banking or an insurance company and that of a non-banking company, the subheadings, the way they have to be interpreted, the way how the loans recovery cost, all these factors will differ from that of a manufacturing company. So it becomes mandatory for the Indian accounting standards to classify the manufacturing and services industry separately. So that's why they said that insurance, banking and non-banking financial company will not be taken as a mandatory step towards this particular standards. Similarly, they also came up with the factor, the general instruction which we are going to talk about today is the Indian accounting standards which are specified are intended in conformity with the provision of the applicable law, which means to say that as per the state law applicable, as per the factor that is applicable, it is confined to that particular law. You have to follow the laws there. However, if due to subsequent amendments, suppose we are going to change the law, suppose we are going to make an amendment, suppose we are going to make any changes, that means a particular Indian standard is found not to be in conformity with that law. Now, for example, the board feels that there is some law which is not properly done, there is some law which has not been properly put across, there is some law which needs to be changed, which needs to be amended, which needs to be looked forward altogether. Yes, we can go forward and change the provisions altogether. The provision said shall prevail and the financial statement shall be preferred in conformity to such law. That means to say from there, we will be changing the law, we will be changing the segmentation altogether. So that is going to be a very, very important factor here. That is what we are going to look here as a factor of matter of growth, as a factor of change altogether. So we are not just going to limit ourselves, but we are going to think, we are going to construct a better standard here. Now, what are we in terms of understanding, in terms of growing here is that suppose a change is coming in or we are trying to bring in new standards or conformity to these factors. What are we trying to do here is that we are trying to enhance the process. We are trying to tell the companies that suppose there is going to be a change, that financial statements shall be enhanced to that level. But of course, this cannot be done on a rapid basis. This cannot be done on an immediate basis. This has to be done over a period of time where you understand what are the implications of it. Now, for example, the way how you might report a loss or an inventory, or we are going to talk about some profit statement, will differ from company to company. Like for example, in a pharma company, the reporting standards might be different from that of a paint company. So what we are trying to do here is that when an amendment is being done with respect to the law with regards to that statement, we will try to look in what is the possibility, the feasibility altogether, so that that provision can be included and further guided accordingly. Now, what the other exemptions that we are trying to talk here is that Indian accounting standards are intended to apply to only to the items which are material. Now, this is very, very important, which are materialistic. That means to say that, yes, we are talking about the physical goods. We are talking more about the manufacturing sector. So that is why we didn't try to include the services, the intangible part into the accounting. We are only going to account for the materialistic things that have been already looked about in this sector. So we cannot go out tomorrow and try to talk about those factors or the pictures which are on the other side or which are on the non-materialistic part. Similarly, the Indian accounting standards include paragraphs set in bold italic so that they are underlined in plain type, which have equal authority. So each and every word that has been penned down in the Indian accounting standards is of a great value and they have an equal power and authority, which means to say that any auditor or any person who's going to go through that law, go through that section, cannot take it lightly. It comes with an power, it comes with an authority. Paragraphs in bold italic indicate the main principles. Even that has been told. What is the main principle? What is the sub-principle? How it is highlighted, in what text they are highlighted has also been told. An individual Indian accounting standard shall be read in context to the objective. What is the objective of the accounting standard? Why have we written that accounting standard? Why? What normally happens is that people just read through the standard just like reading a book. But then you need to first understand the objective of why that law has been set, under what clauses, what conditions, what terminologies. So that is why we say here that shall be read in the context of the objective it is stated, and in that accounting standard in accordance to these general instructions. So according to the general instructions only, we will be writing down the law and it would be interpreted altogether. The list of Indian accounting standards format which I would like to talk here, some of the examples which I like to talk here is the operating segments which is being given under the Indian accounting standard 108. So whatever is your operating segment, it might be in different verticals under which the company is working, FMCG, or you are trying to work under chemicals, or you are trying to work under manufacturing. So all the segments would be mentioned under this particular standard. Financial instruments. So when you are talking about debt, money market, capital markets, all the financial instruments shall be reported under the section 109. Under section 110, that is the standard 110, consolidated financial statement. What are all the consolidated financial statements? Where can I find it? For which you need to go through this standard, the Indian accounting standard of 110. Now, Indian accounting standard 111, that is 111, will try to talk about the joint arrangement. So whatever the joint arrangements company has made in terms of raising a fund or joint ventures or any other kind of factors will be mentioned here. Again, section 112 or the standard will talk about disclosure of interest in other entities. Now, as a company, you might be interested in starting up another business, buying out or merging, or you would like to invest. All those factors will be given here at the 112, followed by the fair value measurement, how your company is valued, under which standard, under which format. So the fair value measurement will be given here, followed by the regulatory deferral accounts. In suppose if there are any deferral accounts, any regulatory procedures or factors that has to be taken, that will be given here. And in the factor of 115, that is the in regulatory act, where we are going to talk about revenue from contract with the customer. So whatever contracts, whatever factors with the customers that we have done, all those factors will be given in. But of course, when I put that star mark, I'm trying to tell you here is that there are terms and conditions under which those customers' contracts will be looked into. Those are the deeper level factors which we will be seeing in the coming sessions. Now, the other factors which I would also like to talk about is the effects of the changes in foreign exchange. This is coming up in a big way these days because of the export factors. Then the borrowing cost. So that is also very, very important. How are you looking into the borrowing cost factor? The related party disclosure. So whenever a company is getting into any sort of transaction, what are the disclosures that you have done? What are the transparency factors? The separate financial statement, each and every segment, each and every company's separate financial statements. Investment in associates and joint ventures. Again, that has been told very clearly. What are all the investments? What are all the joint ventures that has been done? How it has been looked into? Financial reporting in terms of hyperinflationary economy. So, for example, if there are any hyperinflation, that is sudden highs sudden increase or whatever kind of factors in goods or prices, that will also be mentioned according to the standard. Now, the other factor which I would like to talk about is the financial instruments in terms of presentation. So there might be factors, there might be standards, how you are trying to present your financial instruments, how you are trying to go about in terms of telling the people about your financial ratings and other standards. Your earnings per share, which forms a very, very important criteria for the investors to look and understand. The interim financial reporting. Interim financial reporting is one where you are trying to report your financial status on a particular basis, on a particular standards altogether. So your interim financial reporting also that happens in the quarterly basis, half-yearly basis. All those factors will be given according to the IAS standard 34. With this, I come to the conclusion of this particular session. I hope and believe all the information shared here is of a great use and of value. In the next sessions, we will be seeing about the new standards of accounting by the IFRS and by the Indian accounting standards. Until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me on this wonderful session.